No, absolutely. That's wonderful, Jim. And I'm so sorry to even, start to cut you off, but I just realized that Larry has a hard stop in 10 minutes. And I just want to make sure that he's able to answer at least one more question here, because we do have a few. And so if we'd like to, if you'd like to expand more on, because I know you have such a comprehensive understanding and knowledge from a personal and from a work perspective on planning for special needs beneficiaries. So I'd love to circle back to that. But we had a question from Joe specifically for Larry. He said, what are your thoughts on dimensional exchange traded funds versus mutual funds? Are the ETFs similar to the mutual funds?
Yeah, so first of all, everything that Dimensional does is based upon peer-reviewed academic research, so you're going to get the same rigorous analysis and theory and empirical evidence behind their strategies. The fees are going to tend to be a bit lower on the ETFs because they don't have to have the 800 numbers and support lines, to deal with that. But the main thing is this: when you run a mutual fund, you can control the amount of assets under management in terms of the growth. When you own an ETF, that goes away. And so it tends, because there is what's called a creation and redemption process. It's approved participants who can create the new ETFs as demand comes in. So what that means is when you're managing money in large cap stocks, there's almost an unlimited amount of money you can manage, certainly in the tens of billions. If you're trying to run a micro cap strategy, say stocks under $1 billion, you probably can't run more than 2 or 3 billion. So you want to do it in a mutual fund format, which would allow you to cut off assets if it became popular strategy. So what you tend to find with ETFs is that whether dimensional or otherwise, you will not have as deep as exposures to these size and value factors, which have limited capacity, because growth stocks make up a much bigger percentage of the market by definition, because they have higher valuations than value stocks, which are much less than, say, 20%, and small caps are less than 10. So you're going to see less exposure to those factors. So that's going to be the case with sustainable strategies, which are tilted as well. But if you're going to be in the ETF space, dimensional funds are as good as any, if not better. You have the reliability of their research, and we certainly use them in portfolios. And ETFs have the advantage over mutual funds of being more tax efficient. So we certainly would prefer them in taxable accounts. Erica, why don't I think we'll try to give answers to a few more questions quickly here. Got one on tips, I think.
Yeah, absolutely.
Actually, yeah, it's something to be inflation oriented, because we did say that we haven't talked about inflation much.
So we do have something on tips. So we had a question: despite high inflation, why have Treasury inflation protected securities, or tips funds, why haven't they gone through the roof? Is it because of the higher durations tips outweigh tips funds gains? Then why are short-term tips not skyrocketing up?
Yeah. Okay. So first, tips have two components. One, they have a real yield, which then gets added to every month, whatever the CPI is. And that's what the rate of interest gets added. That's your return. But they also have duration, and that means term risk. So just like there's a difference between the performance of a 1-year, a 5-year, and a 30-year bond, if interest rates are going up, the 30-year bond will get hit the most, and the 5-year in between, and the 1-year the least. And if rates are going down, then the long bond will benefit the most. What we've seen is a dramatic rise from exceptional, historically record low levels of real interest rates. In fact, tips yields were sharply negative up until recently. And so that rise in the tips required real rate of return has offset the benefits that you got from the inflation rate. So you have to consider both of those. If you want a pure inflation hedge, then shorter term tips are better than longer term tips. But then you give up the term premium. Longer term tips generally are going to have a higher real yield than shorter term tips. So that's something you need to consider. We think that there are other good ways to address the inflation risk without taking that term risk. We, in fact, use funds that are engaged in what's called middle market private lending. So they lend to companies that can't issue their own bonds. They're not big enough, and the large banks have gotten out of that market after the great financial crisis and the need to restore their balance sheet. So private lenders and hedge funds have taken over that market. And we invest in funds run, for example, by Cliffwater. The fund is CCLFX, for those you're interested. It has no duration. It's 1 month, all floating rate, and it's highly secured loans with average loan to value of less than 50% currently. And the historical default rates, because of that senior secured debt backed by strong covenants, and almost all the loans are also backed by private equity. So they're less likely to walk away if there's a default because their equity would get wiped out. The defaults in this space have been less than about 2% a year, and recovery rates are 70%. So the average loss over the cycle has been 60 basis points, and that includes through the great financial crisis, through the COVID crisis. Current yield is about 7.2%, I believe. So you're getting a massive premium over short-term interest rates, and you have no duration risk. That's one way to address the problem. But tips are the only pure inflation risk hedge without any credit risk, but you can have the duration risk if you're buying longer term ones. Let's see if we could take one more quick question here. I think we had a couple on Social Security, so I'll try and address that very briefly. We have massive federal deficits, unfortunately, due to very bad fiscal policy under both Democratic and Republican administrations. And we had excessively easy monetary policy. In my mind, the Fed has made a big error in waiting way too long to tighten monetary policy. They were behind the curve, and we're going to have to see that be addressed. That alone is going to create a big problem because we have a debt to GDP ratio well over 100%. We're now going to be like 30, let's round it, 30 trillion of debt. So if interest rates move up as they have done from, let's call it 1.5% for a 10-year to 3% or 3.5%, you're talking adding 600 billion a year to the budget deficit. On top of that, Social Security, Medicare, Medicaid will be running out of money, if you will, to fund their full obligations in about 12 years. They will only be able to pay out about 75 to 80% of their benefits. So something's going to have to give here. My best guess is we're going to see changes in the age required to get full retirement benefits going up several years. Reduced benefits to some degree. My best guess would be more income testing, means-based testing, and maybe higher taxes on Social Security and Medicare. So I think that hopefully addresses those questions. I don't have a clear crystal ball, but I think investors should not count on 100% of getting their Social Security benefits. Although that may be possible, we'll see what actions they do take. So hopefully this webinar was helpful for everybody. If you have questions I didn't get to, Jim can shoot me an email and I'll try to answer them, and he could post them on the website. Jim and Eric, I've got to run.
Thank you so much, Larry. This has been terrific.
All righty, you take care.